Hi there, this is Alvin from Dr. Wealth, and today we're going to go through a video to guide you how to value loss-making stock. You know, nowadays we have a lot of stocks that are loss-making but very high growth, and investors like to invest in them. Yes, they didn't do very well in since November 2021 due to the fear of inflation, right? So there's a lot of drawdown for this kind of loss-making stocks. But that doesn't mean that you cannot use valuation to get in at a much better price, right? So today, that's the purpose of going through this with you. Usual disclaimer, pause and read it if you need to. So let's dive into these high growth stocks. What are we talking about specifically? And this table is actually taken from Prof. Damodaran, right? He is the valuation professor in the US, right? So this is the growth stages of a typical company. It starts from stage 1, which is a startup stage. And if it manage to survive, it move to stage 2, stage 3, stage 4, that's where they become mature. And then stage 5, that's where their revenue start to taper, become stable, right? Plateau, okay, should I say taper? Plateau. Stage 6 is where their revenue start to taper. You can see that the revenue growth is how you can define the different stages as with the other metrics. But let's focus on the revenue growth. I will ignore stage 1 because these are usually private companies that are not listed, and most investors would not be able to have access to them unless you're an angel investor or a VC or your friends and family to the entrepreneurs who is doing up the startup and raising money from you. Otherwise, it's usually difficult for investors to invest in this stage. Then we move to stage 2. This is where the earliest chance a loss-making company can make it to the stock market, okay, aka list in the stock market. And these companies in stage 2 should be growing quite fast, more than 50% per year in terms of its revenue growth. And in stage 3, that's where the revenue growth slows, but still at a very fast pace between 25 to 50%. And stage 4, the growth will slow down further. And this point in time, the company is usually a well-known name already, right? People are using their services or products, and that's why the number of or the uncontested market is a lot lesser than what they have used to be, okay, in the past. Then in stage 5, this is where the revenues start to plateau. There isn't much growth, but it keep pace with the GDP, right? And stage 6, there's the decline stage. So when we talk about the loss-making stocks, they are usually in stage 2 and stage 3, but more so in stage 2. Okay, because stage 3, there is a chance where their earnings start to turn positive, their free cash flow start to turn positive, okay, then they are on the road to sustainability. Okay, so that is the usual first point they want to achieve in stage 3, where they turn sustainable in terms of profits and earnings. Whereas stage 2, they are still making losses, they are still having negative cash flow, where they need external funding to keep their business afloat. So if we want to very narrow down from all these 6 stages to one stage, we are talking about the stage 2, young growth company, growing very fast, more than 50%, and then at the same time, they are still not profitable. They need funding, okay? So what funding can we use, right? A typical company can raise money in 2 methods. The first is via the debt, and then the second is the equity. Okay, so there is no other third way. Yes, there are many different ways of raising debts. There are many different ways of raising equity. I'll give you some examples. For example, if you borrow from a bank loan, it is considered a debt instrument. Bonds as well, notes. Okay, so these are the very common ones. And when we talk about equity, examples are you raise money from friends and family, angel investors, as well as venture capitalists. Okay, so these are the examples that you can refer to. Most of the time, you should take one of these line item. Okay, and for these kind of loss-making companies, they usually do not raise money from debt. They usually raise money from equity. The reason is because they do not have assets to collateralize, such that the bank is willing to lend money to them. So why do I make that comment, right? So we understand this asset-light business model that a lot of people have been sharing, talk about disruptive technology platform way of business. Is just many different ways to describe an asset-light business model of the tech companies today. So for example, they say Airbnb is the largest accommodation provider but owns no real estate. Right? It just leverages on the host's properties to lease it out temporary, short term to travelers. Then Facebook is the most popular media owner, but it creates no content because the users are the one that generate the content on the Facebook platform. And Alibaba, world's most retailer in the world, but has no inventories. Okay, so they are just matching, right? They don't sell their own products, and they are just matching the buyers and sellers in the platform. And lastly, Uber is the world's largest taxi company, and it owns no vehicle, right? So you get the idea. And when they have no assets, it's very difficult to go to the bank, please lend me money, okay? Or, you know, when you talk about bonds, there is nothing that they can collateralize, right? So that is the usual issue with this kind of a loss-making company or tech companies, and that is usually not a usual way they raise money, right? They may raise a little bit, but not significantly, and they usually have to tap on equity, and that's why all the funding, seed round, Series A, Series B, Series C, right, all comes about. All these are equity fundraising to fund loss-making company such that they can continue to operate. Okay, so this is what it looks like, right? For a loss-making company, the cash on hand is the blue bar chart, and then the yellow dotted line is the number of months the company is burning, remaining months for a company to survive, right? So the lower, the worse it is, okay? So for example, they may raise a sum of money, right? In this case, about what, $22,000, okay? And every month, because they're loss making and the cash flow isn't positive, so they will run down their cash level. And as they run down their cash level, you can see that the number of months to maintain survivability reduces, right? Until at this point is like about 8 months to survival. And that means that if they still need an extension of this runway, they need to raise money once more, right? So that is the game that a lot of these loss-making companies are doing it. And why would a venture capitalist or angel investor put in more cash to invest in such companies? The reason is because they are usually burning a lot of cash to capture market share, to develop products, to figure out what is the industry standard for their products or service that is the most sticky with their customer, right? So a lot of this discovery work, a lot of all this market capturing work has to be done, and they all cost money before the revenue and the cash flow rolls into the company business itself, right? So that is why when investors see that potential, eventually they can be the number one in the market, they can capture 70% market share, and then they will turn into profitability. It's just that not now. Okay, so they buy into this future possibility, and that's how all this funding happens. And give you an example, right? So loss-making company, if they raise money from the equity side, okay, from the venture capitalists, then you will see that suddenly their balance sheet have a very high cash balance. So for example, we look at Grab, which is a ride-hailing company, and recently they went for a listing. Actually, it's not that recent, last year. Okay, they went for a listing, and they have a large cash pile of about 3.3 billion in their balance sheet, and that's about a third of their market cap. Okay, so you can see it can be quite significant, right? The amount of money that they can raise due to their prospect. And Peloton, okay, this is a fitness company that did well in COVID. Cash balance is almost $1 billion. It's 20% of the market cap. Okay, Monday.com, this is a SaaS business, right? Subscription software for CRM productivity. It's also about close to $1 billion, similar to Teladoc, also about $1 billion. So their market cap their cash percentage to their market cap is about 15-16%. Okay, and then Unity is about 1.2 billion, and because of a much larger market cap, is only about 8% cash of it is cash. Okay, so bottom line is that you can see it can be substantial, and this cash pile is worth something. Okay, this cash pile is worth something. We should not discount it. And the problem is when you use price-based ratio, right? Let's say you use price to sales ratio, because sales is the only positive number. You can't use PE ratio. You can use P over operating cash flow ratio because it's negative, right? So you use a positive number, which is PS ratio. It's essentially just taking market cap divided by total revenue. The cash is excluded, right? Which I told you can be significant. So which means this PS ratio may not be a good ratio to use, although it is relevant. Okay, but it is not the best to use for loss-making companies. And what should you be using? You should be using enterprise value ratios. Okay, so what is enterprise value is based on this formula. It's essentially just taking the market cap minus the cash in the company plus the total debt. So if the substantial cash amount is in the balance sheet of a company, it will reduce the enterprise value, right? It becomes cheaper. So that is how you discount for the amount of cash in the company. And usually for a loss-making company, the debt is non-existent. Okay, so essentially, you're just taking market cap minus the cash in the company to get you the enterprise value. So this is much better than just taking the market cap from the numerator when you use a PS ratio. All right. And then the next thing that we need to figure out is how does the company of all these loss-making businesses get valued? A lot of them are about future, right? A lot of them, the value is in the future. And that's why the revenue growth rate is very important. Okay, it must be fast enough. Like what we discussed just now, stage 2 growth company has to be growing like more than 50% per year. Okay, so the valuation will be highly dependent on how fast the growth rate is. If your growth rate is fast, you can command a higher valuation. If your growth rate is slower, you will command a lower valuation. So that is in tandem. It is not the only factor. Okay, valuation is not the only factor, but it is an important factor. Sorry, growth rate. Okay, revenue growth rate is not the only factor for valuation, but it is a very important factor. Okay, for example, there are other factors like if let's say the company is a market leader, the growth rate has slowed down, but maybe the market share is substantial, 60% market share, it will command a premium as well. Okay, so there are some situations where it is not just growth rate alone, but most of the time the growth rate is a key indicator that investors look out for. Okay, and the next thing is that usually when you use a PS ratio, you will use a historical sales or historical revenue, right? Historical revenue, which is not useful because this historical revenue doesn't take into consideration the growth rate. Okay, it's missing. Right, so what it is 1 billion revenue, so what is 2 billion revenue against your market cap? You need to consider the growth rate because we did establish the growth rate is a critical factor in determining the valuation. So which means that we need that future growth, right? How do we get that? We use forward revenue. Okay, some call it next 12 months revenue. Some just put a year. For example, if next year is 2023, you just take forecast revenue in 2023, or so on and so forth. Okay, so how do you get this forward revenue, right? You might say, I don't have the financial statement next year. How do I know? Okay, the management usually will give a guidance. Okay, then you can use the number, or you can also rely on analysts who study the company, who do a lot of modeling, and you find the consensus, what is the forward revenue, and that's the number you can use. Okay, so this is the ultimate formula. If you want to value loss-making companies, this is what it looks like. It's enterprise value divided by forward revenue. Okay, we covered both the numerator and the denominator already. Remember, we said that why we use enterprise value, because we need to take into consideration the cash in the company. And why forward revenue? Because we need to consider the growth rate that's going forward for this company. Okay, so because all these companies is forward-looking, it's not backward-looking. Okay, it's not about their historical value, it's not about their current value, it's about their future value. Okay, so we need a forward revenue as a metric in the computation. Okay, so that's the formula to use, and you want it to be lower, right? The lower it is, the cheaper you are paying for this loss-making stock. And by itself, it doesn't mean anything, right? So if let's say this enterprise value over forward revenue is 1.5 times, right? But what does it mean, right? Is it cheap or expensive? You always need to compare with something. This is relative valuation. So you need to ultimately use this metric to do a peer comparison. You need to find similar companies in the same industry, in the same geography as much as possible, because you want to do an apple-to-apple comparison. You can compare I don't know, fast food company with a real estate company, right? The metrics are definitely going to be different because the business models are different. So you need to find similar businesses together and make that comparison. Okay, so I'll give you an example, right? On ride-hailers, and we have Grab, Uber, Lyft, and Didi. First of all, it is, yes, they are in the same business, but geographically they are different, right? Uber and Lyft mostly in the US, and Grab is mostly in Southeast Asia, while Didi is in China. So different operating environment will give you different valuation as well. Okay, but this is probably the closest we can get in terms of ride-hailing comparison. Okay, so understand the differences is also important. That will give you a different conclusion when you do your peer comparison. And this is the column of their enterprise value, and this is their forward revenue, and I also put in the forward revenue growth rate. You can see that Grab is actually the fastest in terms of growth rate, expected growth rate. Okay, and this is eventually their EV forward revenue multiple. So Grab is at 1.5 times, Uber is at 1.3 times, Lyft is at 0.6 times, and Didi is at a very, very low 0.1 times. Okay, so based on this comparison, you can see that, as I told you, if the growth rate is higher, usually they command a higher valuation, which in this case looks logical, right? Of course, you can even do a chart or interpolation to see whether how much should Grab trade at if you find that Uber, Lyft are fairer. Okay, so you can do those, but you can even just run through and say, okay, can you justify why is there a premium for this kind of stock? Okay, so for Grab, we can say that because their growth rate is faster. Then for Uber, the growth rate is the slowest, and yet they still command quite a higher price multiple. That's because their market share is a lot bigger. Okay, they are the Uber's market share. You can see that if you base on the we should use revenue, right? The revenue is $36 billion. It's even higher than Didi. So based on their market share, you can say that Uber has a premium as a market leader. Okay, so in that case, you can also explain that. Then in terms of Lyft, okay, so these numbers also look justifiable. The only non-justifiable price, the sore thumb that stuck out the most obviously is going to be Didi. Okay, in terms of growth rate, it's not very far, right, from say Lyft. Okay, yet it is 9 times cheaper. And in terms of market leadership, yes, Uber is number 1, but Didi is number 2. So that should give some premium, especially is number 1 in China. And that also doesn't justify that 13 times difference in terms of valuation. So based on this comparison, you can clearly tell, you can't know whether Grab, Uber, Lyft, which one is cheaper, because they have their reasons and it seems reasonable for them to trade at their multiples currently. But the most obvious one is Didi. Okay, it should not be trading at 0.1. It should be probably trading at, I don't know, 1 times. Okay, 1 times kind of forward revenue multiple, or even 0.9 together with Lyft. So there is a lot of that market cap to catch up in terms of Didi. But of course, we also know that there is this regulatory risk that's going on in China. It's not lifted yet for Didi at the point of recording this video, even though there were rumors that the regulation is going to end for Didi as well, right? So that is, they are pricing in the risk, okay? But do you think it's excessive, right? So that is the other analysis that you need to put in, okay? So that is how you use the EV forward revenue multiple. Okay, you need to do a comparison at the end of the day, and you need to make the assessment. Okay, so that hopefully you can find one that is obviously cheap. All right. So in conclusion, as I shared with you, price-based metrics don't work so well for loss-making companies, and use enterprise value because it considers the cash in the company, and enterprise value will have discounted it. And the second thing is that we need to look forward. The growth rate of this loss-making company are critical to their valuation. The higher the growth rate, the more valuation they command. Okay, so use future revenue growth, forward revenue, rather than historical revenue. And you put them together, this is the ratio that you're going to get, enterprise value divided by forward revenue. And the lower it is, the better. Compare with a group of peers that are equivalent as much as possible in terms of business model, industry, as well as geography. Okay, so I hope today's video has been useful for you, and now you know how to value loss-making companies. And if you like this, remember to give me a thumbs up for this video, as well as to subscribe to our channel so that you will get more useful videos like this. Don't miss out, and I'll see you around. Goodbye.